Welcome to Winning Wall Street's Money. Help support my channel. We need to get to 1,000 subscribers pretty much as soon as possible. So then I go live streaming because YouTube policy, they won't let me go live until I have 1,000 subscribers. Thank you to all the folks out there that have subscribed to my YouTube channel. If you have not yet, please take this moment now with helping me. Click subscribe. Next, click the bell. And next, click all. This helps you receive a notification when I post my next videos. Plus, click the thumbs up button and every time you watch my videos. If you got value from this video, if this was helpful, then please consider sharing a small monetary donation to my channel by going below and clicking on either my Patreon or PayPal links. If you join my Patreon page, then you'll get early access to these videos 24 hours before they're posted on the YouTube and lots more. If you prefer just leaving a small tip, click on PayPal. Either way, then you get that warm sense of satisfaction years down the line knowing that you helped me become a successful YouTuber. Friday, June 24th, 1:13 p.m. New York time. Happy Friday, folks. Next weekend comes into a holiday. We'll be coming into the holiday of the independence. Often that's a bullish bias for the markets. Doesn't mean we're not going to have a flush downward before this occurs. But again, be aware. Options, part 3. I have the underlying loaded up, stock symbol SPY. Again, that's a stock ETF of the S&P 500. This is level 1. That's what level 1 is. Just the minimum information that the brokers provide. There's more to that, but that's in other videos. Looking at the option chain, all these contracts are contracts that are available to trade. Since we're coming into a holiday, let's look at the bullish bias side. And let's look at contracts that expire next Friday before the holiday weekend. So those will expire July 1st, 2022. Yep, so this trading platform offered by Thinkorswim shows the calendar day on the left, followed by the month and then the year. And then in the parentheses, how many trading days are left? 7 trading days, including today. So we'll open up that option chain. Right now I've queued in to show 25 strikes. These are the strikes in the middle. Right there on the top of the strikes. I can reduce it or increase it. On the left are the call options and the right are put options. You have the bid and the ask for the call option, bid and ask for the puts. The underlining, being SPY, is at 387.43. So let's look at the nearest strike. Here's the strikes, go down, 387. So if you're bullish, think prices will go higher between now and by the close of Friday, next Friday. Where we go, we're going to look here. Again, these options for the stock market trade from 9:30 a.m. to 4 p.m. Put a trade on now. You don't have to wait till next Friday. You could close it today. Put a trade on now. You could close it Monday. At any time during the stock market hours, you could open and close positions in the options market. That's good. And the S&P 500 futures, you have more hours to be able to open and close option positions. But here we're looking at options on the stock market. Okay, so the underlining 387 plus some change. So the nearest strike 387. So go here on the left. Ask 571. Bid 569. Just like stocks, you buy on the ask and you sell on the bid. So if you're bullish and think prices are going higher in the stock, you'd be buying at the ask. If you think stocks are going lower, you would sell at the bid, which is shorting, make money on the downside. Yep. So here, 387. If you're bullish, you're buying at 569. That's 5.68 now times 100 shares. 500 $69 for one contract. One contract. That contract would be a 387 strike. And that's the 1 July contract, 1 July, 387 strike on the call side. So when you use the wording, you want to be really, really certain you're using the right words. The contract is the expiration, 1 July. This would change after the market closes today. Might update Sunday, might update after the market closes, but before the market opens Friday morning, this would change. This would be a lower number. So again, the 1 July call and the strike 387, or some people would say the 1 July 387 call. That's real basic. On the verse puts, there we go, puts. If you think price is going to decline, go lower. Well, just like stock, if you think the stock's going to go lower and you're bearish, you'd be shorting the stock. You're shorting at the bid. Well, here, if you're bearish and you think the underlying is going to go lower, you actually buy the puts at the ask. So again, 387. I'm just giving this a strike example because it's the nearest strike to the underlining. We'll get to later these other strikes, but the nearest strike 387. So if you're bearish, you could buy a put, and you buy it at the ask 520. Okay, you could do both if you want, but back on the call side. So if you buy the call because you think the underlying is going higher, 387, and you buy it at 562, whatever it is now, and then if and when this price goes higher, these prices go higher. That's good. That's good. But this is a financial instrument. That's a derivative, and this derivative is a contract that has expiration period. This stock does not have an expiration period. So part of this prices, and these prices are called premiums. Part of these premiums have the value included in it of time. Yeah. So typically options that are under 25, 20 days, the premium starts melting away faster. Yep. So these prices decay faster because there's less time left in them till they expire. Well, some people don't like that. Well, it's going to happen, and you have no control of it. But what you could do, some people go further out. They go further out. There might be contracts that wait till 35 days, 84 days. So let's just open this one, 84 days. Same strike, 387. 387. But look at the price, $1,892. Yeah, that premium costs a lot more. Again, we're focused on a timeline between now and next Friday. Why would you tie up all that capital so far out if this event we're talking about is occurring shorter? Well, because some people are not trading a shorter duration for whatever reason. So you could day trade these too, but if you're going to day trade these options, it's best to day trade contracts that are the same dates that expire, because then there's much more activity occurring. And again, these prices are much more truer to the value of the underlying because most of the premium that I mentioned, time, is already out of it. But understand, these options you need to close before the end of the day because they will be down to zero at the end of the day when the market closes, and there's nothing you can do with them after they expire. They're worthless. Yeah, it's required work to close it. So again, it's Friday. The 387 contract right now is $114. So if you think it's going to go higher, you can buy it at that strike price. And back here on this one, I think between now and next Friday, or anytime between now and next week, the 387 call is going to be higher. You can buy it at this price, 558, and sell at a higher price if it goes so. Well, if you're contrarian and if you think we're going lower, you can certainly buy 387 put 521. And if it goes lower, you can close it for the difference Let's go here. We're looking at a daily chart, the S&P 500. Let's label that strike price. So 387, 387. We'll go right here. We're going to be a horizontal line, 387. Yep. So we need to strike the stock, not only to stay above 387, but to continue going higher. If it continues going higher, you're going to be making money. So if the stock retraces lower, then your call option will be losing. If the stock's going to do a consolidation, this is a consolidation, you're going to lose money because part of that option is price and time decay. Let's look at the weekly. Now these are weekly candles. Weekly candles. Yeah. So let's another selection. Maybe you want to go using less capital. Less capital, well, these strikes, and maybe you think it's going to go higher to 390. So let's do that. Let's change this from 387 to 390. Now this strike 390 is no longer at the money. It's higher than the underlining. Again, we're looking at the weekly here. Let's look at the daily chart. 390. There's the underlying. Sure, 50% chance it could go up there. 50% chance to go lower. Let's look at the 390 here. 390 strike. 390 strike on the call side. It's $408. Yep, it's less money. So that's another thing to do if you want to use less capital. There's a lot more you need in your favor because it needs to, again, move up. This price needs to move up to 390 and higher for this value to continue going up because, again, we're working in time decay. When you buy options, regardless if you buy calls or puts, they have included in the premium time decay. So either way, if you buy a put, the stock, the underlying needs to move down rather rapidly, as well as if you buy the call, the stock needs to move up rather rapidly, or part of that premium is going to melt away. So you already see these prices here. You can check this video at the end of today, Monday, Tuesday, anytime between now and next week, and see how it works out. This is one of many strategies. Many thanks for watching.